All right, so today we're going to be talking about how do we use this information in financial statements to understand our decision making, right? Basically, just deep dive into how do we use financial statements in practice to evaluate things. All right, so we're going to talk about cause of change analysis, common size financial statements, trend statements, and financial ratios. I do want to point out, please use the ratios that are provided in this PowerPoint and on D2L. Focus on these ones. If you go search things online, you might get different results. So whenever you're going through your project, focus on using these ratios and not something that you're just going to find online. So very important caveat there. You might find different ratios under the same title. And while you might be directionally correct, you want to make sure you're actually correct for the sake of this class. So use what's in this PowerPoint and post it on D2L and not what you're going to find in a search result. Yeah, basically, already what I thought. All right, so one of the ways that we can view financial statements is over time and cross-sectionally, right? Time series cross-sectional analysis. That's the other frame that you're used to understanding data analysis when you go through sort of statistics class, right? So what is time series analysis? That's you looking at a single observation, a single ID, right? As a single company over time. Right, so time series analysis is helpful when you're examining a specific entity or specific group of entities, and you're only focusing on that over time. Right, so for the case of your project, phase one of your project is you focusing on this single company. Right, you're going to be looking at it over time and analyzing that. So that's going to be a time series analysis. Cross-sectional analysis is when you're looking across firms, right? So that's going to be more phase two of your project. You're going to be taking the company that you initially examined and then comparing it with the rest of the companies in your industry portfolio that you're going to be comparing. All right, so these are the two broad perspectives when understanding financial statements, right? Time series, cross-section. Relatively straightforward, but there's quite a bit we can do within these analyses. All right, and so one of the time series viewpoints of understanding a company is through cause of change analysis. All right, so the broad goal here is to understand what are the results from changes that occurred. All right, so we're trying to identify what exactly went right, what exactly went wrong, and how can we improve that in future years. That's the main goal behind cause of change analysis. All right, so we are going to be focusing on profits, this being purely financial statement analysis class, but if we have extra time, probably next class we'll also go over a similar example looking at cash flows. All right, but the broad idea is, did we increase or decrease value, and what are the exact changes that led to those increases or decreases in value? All right, and the way that you go about implementing cause of change analysis is literally changing each input one at a time and looking at what its effect is on the bottom line. All right, so let's say that if your net income goes from 100 to 50, what causes change in performance? We want to know. It could be a change in revenue. It could be a change in operating costs, a change in fixed costs, a change in taxes. All right, so there's a lot of things that can go on that can lead to this result. It can also be a combination, and usually that's going to be the case. Right? Typically, it's not going to be one thing that results in a different profitability. It's going to be many things. And it's going to be the combination of those things that overall results in the change in profit that we observe. All right, so I think the easiest way to do this is just jump straight into the Excel file. All right, so a couple important things here to note out. You have to understand your income statement before you set it up. For the most part, income statements are set up pretty similarly, right? You have revenues at the top, then you have your expenses, then you have your net income. Sometimes there can be some very unique ways of companies reporting expenses. One of you, I think it was, Darden, has a really interesting way of reporting their expenses that doesn't really add up the way it should. But typically when you're looking at the income statement, all the costs should add up to reflect your total operating costs. Okay? So understand your financial statements and also understand how the information is being reported. Right? So sometimes financial statements will be set up that you literally just add all the values in there. Sometimes you have to subtract them out, right? So for example, in this case, our total operating expenses, those are being subtracted from our revenues. And in this case, we're going to have to literally subtract it, right? So we'll take the revenues minus the expenses. That's going to bring us to our operating income. Other times, your company will put the values in as a negative number, right? So you might have the parentheses reflecting negative value in dollar terms. So if you have those parentheses there, if you have a negative operating cost, you add it to subtract it out. Right? So be mindful of how the values are being reported in your income statements, because that's going to mechanically change how you go about calculating the operating income. Right? So that's one of the other ways that income statements can be relatively unique. Right, but also, just going through line by line, it should make sense, right? If you understand that income statements start with revenue and then you deduct all the expenses and costs of the company to arrive at the income, then you understand that at the bottom line, you're going to have to deduct these expenses, right? So if they're reported as a positive value, you're going to subtract it. If they're reported as a negative value, you're going to add it. Oh, a couple other notes that I noticed in the financial statements that you submitted. Regularity is very important. One issue I saw in some of your formatting was having spaces between your columns. If you have standardized spaces, so like one space between each one of your financial statement columns, that might be okay. I would argue that you shouldn't have that at all, that financial statement years should be directly next to one another. But I saw one of you did submit financial statements with irregular spaces between years, and that is not good. You don't want irregular spacing between information in Excel. You want things to be basically consistently input. So when you have a year of an income statement, put the previous year or next year directly next to it. Don't skip over one space, preferably. And having irregular spaces like 2 between 1 year and 1 space between the next year, that can lead to some serious formatting issues. So we have the income statement for Amazon posted here each year side by side. Since we copy the information directly from Edgar, it's just raw numbers here, right? So what we're going to do is we're going to start calculating our percent of sales ratios. All right, so what these ratios here are doing now is these percent of sales ratios are getting all the expenses as a percentage of the revenue being generated above. All right, the reason that we're doing that is we're basically going to create another income statement, but now it's going to be one that is variable, that's using cell references that we can use to calculate things. And then we're going to use that for our cause of change analysis, right? Whenever you're dealing with Excel, it's best that you are using cell references and not just raw data values, because a lot of these values are related to one another, right? That's kind of the whole point of financial statements. This information is all related to one another, so we have to understand what exactly those relations are and set up our financial statements to accurately reflect that information. All right, so we're getting cost of goods sold as a percent of sales. So we take our cost of goods sold for the company and divide it by total net sales. Then we have the remainder of our operating expenses. Non-operating expenses, tax, and investment activity. All right. So this is the information that we're going to use, and we're going to basically flip around our percent of sales method to now get our reformatted financial statement, our reformatted income statement. So again, income statement, you're starting with revenue at the top and deducting all your expenses from there. All right, so we set up our reference for our revenue in 2020, 386,000. And from here, we start deducting our costs. We have our cost of goods sold. As a percent of sales, it's 60.4%. In the previous year, it was 59%. All right, so that 59% times the sales of that year gets us to our 165,000 operating cost. Again, we can check this in the original financial statement. Everything we're getting in this reformatted financial statement should line up exactly with the income statement as reported. Right? This is basically just a sanity check to make sure we're going through and calculating correctly. Brings us to our gross profit, which is revenue net cost of goods sold. Net out the rest of our operating expenses. So again, everything highlighted basically under the cost of sales. And this brings us to our operating income. Right, gross profits minus other operating expenses. Add in our non-operating income. Usually that's a very small fraction of the overall income of the company. That gets us our income before taxes. Not at any taxes, investments, and that brings us lastly to our net income. Right, and see our net income, $21,000, matches up exactly with the net income in the income statement. That should be the case. Right? This is basically just setting up our cause of change analysis. So we started with our raw net income, just flat out numbers. We got our relevant ratios. So in particular, the percent of sales ratios that are relevant to arriving at net income. Reformatted the income statement so that now that's all reference based, right? So this is all stemming from our revenue being generated and then our percent of sales ratios that we have calculated, and we are arriving at the same net income that was reported in the income statement, as we should be. Right? All we're trying to do now is get our setup for the cause of change analysis. Right? So when you're setting up your reformatted income statement, you should be arriving at the same result. Same thing when you set up your balance sheet using this method. Any questions so far? All right, so now we get into the real reason that we're here, the cause of change analysis. So with the cause of change analysis, like I mentioned, we're evaluating the change, the resulting change on the bottom line from the inputs. So we're starting at the top and working our way down the net income, the income statement, to see what the change in the bottom line is going to be. All right, so we're starting off with our baseline of 2019, the previous year. All right, so this should basically just reflect what we have already calculated in our percent sales income statement above and arrive at the same net income, right? 11,588, 11,588. All right, everything works out. Now from here, we're going to start changing the inputs to this financial statement and see what is the resulting change in our net income based on this change in input. So starting from the top, we are adjusting our revenue. Right, so we're updating our revenue to now the current year's revenue of $386,000. Right? So this is the only material change that we're making. We're only changing the revenue, but keep in mind, most of the preceding expenses are directly linked to revenue. Right? So for example, we didn't make any changes to the inputs of cost of goods sold. We're still using that 59% from 2019. But nominally, the cost of goods sold increased from $165,000 to $227,000. Why do you think cost of goods sold increased when the only change we made was in revenue? Exactly. Cost of goods sold are directly related to revenues, and so every dollar of sales increase is going to have a proportional increase in the cost of goods sold. Cost of goods sold is literally a cost necessary to generate the revenue that's being observed. So if our revenue increases, even if we make no adjustments to how cost of goods sold is going to be changing, it's still going to be mechanically increasing because it is directly tied to this increase in revenue. All right? And so similarly, because of how we constructed this financial statement as a percent of sales, the rest of the line items in the income statement are going to be related to sales in that manner. All right, so cost of goods sold increased, revenues increased, and we see that our net income goes from $11,500 to just under $16,000 with this change in revenue. All right, so by just looking at the change in revenue, we see that there is an increase in value, right? An almost 40% increase in income being generated just from that increase in revenue. All right. But we saw an almost 50% increase in our net profits. So there's other stuff going on, right? This isn't the end. This is just the start of the cause of change. So our revenue increased from 280 to 386,000. Next step, basically just walking down the line items in the income statement. What happens when we change our cost of goods sold? Our cost of goods sold went from 59% of sales to 60.4% of sales, right? Not even a 1.5% change in percent of sales costs, but that small change results in a reduction of almost 30% in our net income, right? So I know I've mentioned this before, but small changes can lead to big results. That's the case in your own personal financial lives. That's the case when you're looking at financial statements. There was a 1.5% change in the cost of goods sold as a percent of sales. That resulted in an almost 30% decrease in the profits of this company, right? So cost of goods sold only rose from 59 to 60.4%. Profits decreased 28% from this single change. All right? So small changes can lead to big outcomes. It's very important that you keep that in mind, right? Don't neglect a single percentage point change. It can lead to big results in the bottom line. All right, now we keep working our way down the line item. This brings us to our gross profits. The next things that might change is other operating expenses. So we go back up. Other operating expenses decreased from just under 36% to 33.5%. All right, so we see that our other operating expenses decreased a little bit, but again, little bits can add up. This resulted in our net income going from 1158 to 18,000. In other words, a 61% increase in our operating income. Again, small changes can lead to big outcomes. Always keep that in mind. From there, we have our total non-operating expense added back, netting out our taxes, and then adding in any investment activity. All right, and so now this brings us to the bottom line of our cause of change. If we look at the sum total of all of the changes in our income from each one of these decisions and add that to our starting net income, we arrive at the sum total of this year's net profit of 21,000. Right? 21,033. You can't see it in the back there, but it is adding up. All right? So now we figured out exactly what has changed from 2019 to 2020 that has resulted in the change in net income. Right? So we started from this 11,588, and from there we start from the top line of the income statement, worked our way down. Change in revenue. We increased our revenue. That increased our net income 37%. Cost of goods sold increased though too. All right, so every dollar of sales was a little bit more expensive to produce in this year, and that reduced our net income 28%. While at the same time, we've kept our fixed costs relatively consistent. So on a per diem basis of revenue, that reduced our costs and that increased our profitability. The rest of the changes were much smaller in magnitude, right? Net operating income, non-operating income increased slightly. Taxes decreased. That is something that managements have relatively little control over. Right? It's typical for companies to spend money on lobbying. They can manage their capital structure a little bit by issuing more debt to reduce their taxable income. But taxes are for the most part, going to be out of a company's direct control, and then investment activity added back in. All right, so overall, what are the three largest effects on the company's net income in 2020? Yeah. Basically, if we look at this as how far away from zero are we can rank order this completely. Change in other operating expenses was the largest effect on the bottom line. 61% increase in net income just from reducing our non-operating expenses. From there, increasing our revenue, increased our net income 37.6%. After that, change in cost of goods sold. All right, if we look at the absolute value of these changes, that's the third largest effect on the bottom line. An almost 30% reduction just from a 1.5 percentage point increase in cost of goods sold. Right, from there, change non-operating income, taxes, and investments. And very often you do see that these three are going to be one of the largest drivers in changes in net income. From there, taxes, non-operating income can kind of vary year over year, especially if there's a change in the tax regime. Right? Did something go on around 2020 that may have reduced companies' tax exposure? COVID? Yep. Some companies got a little aid for that, but there was also a change in the tax regime. Remember, there was a change in the corporate tax code around this time, right? So changes like that, companies might lobby for, but it's going to be direct. It's going to be difficult to directly tie any changes in the tax code to individual operations of a company, right? So changes like this, they can be drastic and can have significant effects on the company's bottom line, but it's not as much in a company's individual control. What companies do have control over, to a large degree, is the revenue, right? Are you producing goods and services people actually want? You can control your costs, right? Cost management is significant in its effect on the bottom line, as we can see here, right? Two out of the three largest drivers of the net income were from changes in expenses of the company. Right, so that's why there's often a lot of discussion on cost management. It is necessary to incur costs to produce revenue. It's important to keep in mind the circular feedback of economic growth that, right, employees are cost to a company, but at the same time, we end up typically being the consumers of that company as well. So, right, there's a lot of feedback going on here within the financial statement itself, but it's important to see what are the largest drivers from that. All right, so what are some of the changes that companies can do to try to increase their revenues? Mm-hmm. So I think that, yeah, I think more specifically, there's one particular cost that might be related. So Amazon lays it out explicitly above here. Marketing. That's one of the significant drivers for increasing revenue. If nobody knows your product or service exists, who's going to buy it? Right. So it's very important that people know what you're trying to sell exists. So marketing is a very big one. They don't explicitly show research and development here, but I'm pretty sure that would fall under technology and content for this company. But actually investing in value-adding projects, things that people want to consume, that they want to buy. Right? If you're not producing that sort of good or service, then you're not going to be generating that revenue. Right? You can't rely on the first iPhone to carry out the rest of the future. You need to be developing new things over time that people are going to be interested in buying. All right, so those are some things that we can do to try to increase our revenues. Costs, right? Trying to produce things more efficiently, trying to get more out of fewer inputs. Right? This can go awry when companies get a little too stingy with their cost management. It can lead to negative results, but in general, right, if you can produce more with less at holding the quality consistent, then everything else equal, you're going to be generating more net income. Any questions on the cause of change? Yes. Yes. I don't think I would say that it's the number one driver. I mean, I think the number one driver is having something that is worth buying. I think that is going to be the top point, right? Because Amazon, we think of it as consumers as being like that marketplace to go buy things, but a lot of its value drivers actually stem from its web infrastructure, right? Amazon Web Services. That's one of the largest value addition components of this company, is providing that structure for businesses mostly. Right, so having things that people actually want are probably the most important thing, making those value-adding investments, right? We talk about it all the time in our corporate class, finding positive NPV projects. But yeah, marketing is a necessary expense to let people know that this product exists to purchase. So marketing shouldn't be forgotten. Any other questions? All right. So this is going to be the next step for your project. Thursday, we'll go over putting together this table from scratch using Walmart as an example. But I think just an important topic to start talking about, right? So cause of change, we're trying to figure out what exactly is leading to the bottom line change. What are the main drivers for that? All right, common size financial statement. So you already saw this within our cause of change analysis. When we're looking at a common size financial statement, the main goal is to have a baseline comparison. So when we're looking at a percent of sales method of putting together our income statement, what we're doing is we're tying every line item that follows revenue directly to that revenue production. Right? So looking at things in a common size understanding is a really good way to understand the true nature of any change in an analysis. All right, so a couple examples here. Of these two companies, which one would you argue is more profitable? A company that's generating $1,000 in profit from 2,000 in sales, or $100 profit from 150 in sales? Which one of these companies is more profitable? $100 profit? Hey, 1,000? Okay. All right, so a little bit of disagreement. What about which company has more debt? Right? Let's say $1,000 in bonds with 2,000 overall in assets, so 50% indebted, or $100 in bonds, 150 in assets, 2/3 indebted. Which one of these companies has more debt? All right. All right. Seems a little more unanimous on that. It really depends. Right? So technically speaking, right, if we define profitability as the nominal level of profits, the $1,000 is more profitable. But that ignores scale. It ignores how those profits are generated relative to the sales, and similar with the debt argument. Generally speaking, the relative measures are going to be the best way to evaluate performance. Right? So I think most everyone mentioned $100 in profits based on 150 in sales. Relatively speaking, that is true. Right? You have a higher bottom line relative to your sales. So of these two companies, the second option is generating profits relatively more efficiently. In the second case, right, again, second option is relatively more indebted. Right? 2/3 of the company is funded through debt relative to overall assets, so that is a more indebted company. So broadly speaking, relative measures are usually going to be the best way to gauge performance. Yes? So, yes. I think understanding that point is the literal answer, right? So if you could be able to say, nominally, yes, the $1,000 or more, but relative to the sales generated, the second option is generating that profit relatively more efficiently, right? So in a certain point of view, right, quoting Obi-Wan, they're both correct. It just depends on your perspective, but generally speaking, relative answers, relative measures are going to be the better way to approach it. I wouldn't say it's wrong to say the second option is more profitable. I would say it's more accurate to state relative to sales, the second option is more valuable, is more profitable. Right? Nominally, obviously it's the first one. Right? So understanding those differences is probably going to be the more important point than having an explicit answer for which of these two options is more profitable or more indebted. Any other questions? All right, so another measure that might help make some sense of this too is also when you look at the stock markets, whenever you're looking at the news, typically tickers are giving you their percent change of a given stock price. And usually that's more relevant, right? It's the percent change, the growth in stocks over time that is more important than the level that they are changing from, right? All right, so when we go about actually making these common-sized statements, there are some standard ways for putting together the common-sized analysis. And typically, it's based on top or bottom lines, depending on whether we're looking at income or cash flow statements or balance sheets. So when we're looking at an income statement, typically we size everything relative to revenue, just like we did in the cause of change analysis with Amazon, right? So when we calculated these percent of sales, we are looking at these inputs as they're related to sales, right? So cost of goods sold as a relation to sales. Other operating expenses as it relates to sales. Now, so that's what we're doing when we're looking at income statements, is we're tying everything back toward revenue. Revenue is basically the link between the sizing on the income statement. With the balance sheets, we're typically looking at total assets or total liabilities, right? When we're dealing with real-time balance sheets, they should be equal to one another, right? But when you're looking at a balance sheet, typically you'll be sizing everything relative to assets. So you'll take cash divided by assets, property, plant, and equipment divided by assets, and so on. Right, and when you're getting these common size, do you want to be looking at them as a time series or cross-sectional? And again, it depends. Right? That's one of the things that's important to understand in this field is it's not necessarily that you have a correct answer. There are general methods that are appropriate for any analysis, but there are many ways to arrive at what would be an appropriate answer. All right, so for example, when we're looking at an income statement and taking a common size, you could do within each year. You could also pin down the revenue at the start of a time period. So we could pin everything toward the revenue at the start of, say, 2019 if we want to look at the growth of changes over time. And it could also be cross-sectional. If you want to compare a company to competitors and such, you can size everything relative to each company's revenues and then determine, which one has the best cost control of them, which one is resulting in the better net income being generated. Right, but the whole point of common size financial statements is having, again, an equal footed basis to gauge value. So the most important thing to keep in mind with the income statement is scaling to revenue is basically giving us what percent of our revenue is being tied up in cost of goods sold, in selling, general, administrative, in marketing, in typical interest payments and taxes and so on. With the balance sheet, how much of our assets are being tied up in the different sections of the balance sheet of the assets, right? How much of our cash is being tied up in cash itself, in property, plant, and equipment, intangibles. Right, so the whole idea here is just for us to have an equal footed basis to gauge the rest of the inputs on financial statements. All right, so what we have here is Kroger's income statement from 2014 to 2017. Basically, what we're doing is we're looking at things as a percent of sales within each year. All right, so within each year, what does our cost of goods sold look like relative to our revenue? Generally speaking, we would like to see costs as a consistent percentage of sales or decreasing over time. All right, so what we see here is a relatively steady decrease in cost of goods sold relative to sales. So meaning the company is producing the same dollar of sales with less dollar being tied up in cost of goods sold. Operating and administrative, we see the exact opposite trend. So where we saw this almost full percentage point decrease in cost of goods sold relative to sales, now we see an almost 2 percentage point increase in operating expenses over this time. Or sorry, selling, general, and administrative expenses. Right now, the rest of the line items are going to be relatively small. First two, cost of goods sold, selling, general, and administrative, usually make up the vast majority of expenses that companies have ongoing. But we do see slight increase in depreciation and amortization relative to sales. But if we go straight to the bottom line, we see that that's been pretty consistent. Generally speaking, when you're looking at a common size income statement, if you look at the top and the bottom, you see a pretty clear picture on what's going on. We see net income has stayed roughly the same. Largely that's attributed from the mix of the largest costs staying roughly the same. But as we break it down a little bit further, right, slight decreases are offset by slight increases. Right, and that's basically the point of looking at a common size income statement, is to point out where exactly changes are occurring that are resulting in the observed incomes. Same idea with cause of change analysis, just another way to look at it. All right, now we're looking at the balance sheet, but now scaled to assets. All right, so everything is related as a percent of assets. Here we're more concerned with how much cash is being tied up in the production process. Usually that's going to be from receivable to prepaid expenses. Has there been much of a change? Slight change, right? But that's likely going to now be offset by a slight reduction on the longer held assets. So we do see that in property, plant, and equipment. It goes from 58.7% of assets down to 56.6% of assets. All right, and everything else equal, cash flows are inversely related to the cash being tied up in the production process. So this is likely suggesting that the company's cash flows have decreased slightly over this time, just based on change in net working capital. All right, next we're going to be looking at trend statements, right? So this is basically, with the common size we're looking at within each year, within each time period for a company. Now we're trying to see, has there been a consistent change across time for a given company or industry? When you're engaging in trend analysis, typically you'll use the first year of your sample period as the baseline. If you're dealing with a group of companies, use the earliest common year between them. Right? So say for part 2 of your project, if all of your 3 out of 4 of your companies have 3 years of financials available on their most recent statement, and one of them has 2 years, use that second period as the common size period for all the companies. All right, so in this case, again, looking at Kroger starting in 2014, we're using revenue of that year as our baseline, and then looking at changes from there. All right, so basically what we see going on here is we see a consistent increase in revenues. Over this time, we still see an offsetting increase in cost of goods sold and a larger proportional increase in selling, general, and administrative. All right, we see other expenses increasing as well, and so the mix of the increase from revenue net of costs results in still a roughly 10 percentage point increase in net income. Right, and so looking through here, you can start to get an idea on what these trends look like over time. Has the company's revenue increased? Right, for a well-operated company, that should generally be yes. But from there, we have to look at, between that revenue and income being generated, what are the trends in the company's costs? Right? As revenue increases, we should expect there to be an increase in the cost of goods sold. If the company's operating well, though, the increase in the cost of goods sold will be slightly less than the increase in sales, and that's what we happen to see here. Right? But we do see that this is somewhat offset by some of the other expenses that the company incurs. Right? For operating and administrative, that has increased almost 25%. Rent has increased almost 30%. Depreciation and amortization, right, increased 25%. All right, so these are relatively large percentage point increases, but because they are making up smaller and smaller fractions of a company's proportion of revenue, they do not necessarily offset the increase in revenue, right? Not necessarily resulting in a reduction in profit. All right, similar with the balance sheet, right? Like we saw when we were looking at the common size statement, we see that there's been a relative increase in the current assets that are being tied up. And again, always keep in mind the economic nature of the balance sheet. Liabilities are cash coming in, assets are cash being tied up somewhere. So an increase in current assets reflects an increase in cash being tied up in the production process for producing whatever good or service the company is engaging in. All right, so we've seen an increase in the total current assets, and those total current assets have increased somewhat larger than the overall asset base for the company. All right, but based on that initial common size balance sheet, it's not as much as I would have expected. All right, we see an almost 25% increase in total current assets, but that's offset by there being about a 22% increase in the overall assets of the company. Right, so you can get different pictures from different ways of looking at these financial statements. Any question on common size or trend analysis? All right, so there are a lot of financial ratios. We're not even going to be covering, I would say, not even the majority of them in this class. The important thing to keep in mind is not necessarily memorizing every one of the financial statements, but just trying to understand really what information we're trying to get out of these financial statements, the purpose of using them. Okay? You'll have the financial statement sheet available for you on the exam, stuff like that. And you'll have it available for your project. So memorization isn't the important thing. It's understanding the key mechanisms on why we are using these to evaluate the companies. And like I mentioned at the start of class, focus on the financial statements presented in this slide and available on D2L. Again, there's a lot of information on the web. That's great. Not all of it is the same, though. So use the information provided in this class. Don't rely on search results, at least for the sake of this class. I saved the wrong version of this. Okay. I'm going to send you an updated, I'm going to post the updated slide. I thought I had it posted right before class. But I also want to include the DuPont identity. So return on assets, right? By definition, it's net profit divided by assets of the company. What we're trying to look at here is what asset base is needed from this company in order to generate revenue and ultimately profits that this company is earning. Everything else equal, the higher the return on assets, the better value generating potential of the company is. Let me see if I can actually find a quick. All right, yeah, this will work. The other thing that I wanted to show you that I think was a little bit more relevant is looking at return on equity through what's called the DuPont analysis. Basically, it's breaking apart or expanding the return on equity to reflect three significant inputs that companies have. Right? Net income relative to revenue. So what is the company's bottom to top line percentage? The more efficient you're capable of generating that bottom line from the revenue, everything else equal, better that income is being generated. How much assets do the companies need in order to generate that revenue that's being used to arrive at that net income, right? So typically we link income statements from the bottom line of the income statement to the bottom line of liabilities on the liability side of the balance sheet. But we also know that those assets are needed to generate revenue, right? Companies can't generate revenue out of thin air, right? Even with Amazon, when we're looking at web infrastructure, when you're looking at cloud services, right? For you, that might not seem like anything is going on, but there are other companies that are using significant computing power to provide those services, right? So assets are needed to generate revenues. How efficiently is this company generating those revenues? And lastly, how much liabilities, how much debt do they need to fund the assets that they use to generate their revenues? Right? So this what this DuPont identity is showing us now are different levels of needed financial constructs to produce the bottom line, right? You need revenue, you need top line income to arrive at bottom line income. To produce that revenue, you need assets in place that are productive, that are generating that value. And you're also likely going to need capital in order to fund that initial use of those assets. So what the DuPont identity is showing us now is the breakdown of all those inputs, and we can see when we're looking at return on equity and break it apart into DuPont is how much of the value is being generated from revenue productivity. How much of the increase in value is being generated from our asset productivity? and how much of it is being generated just from our pure increase in capital that we're using to fund these operations. All right, so we have 3 different levels of being able to gauge companies' performance just by breaking apart the return on equity. Right, and basically what we saw with that DuPont analysis is the bottom line of what we're trying to accomplish when we're using a financial ratio. We're just trying to get better information on the performance of companies. Right. Now we're looking at a bunch of different profit measures. Right. So we have gross profit. This is basically top line profit of companies being generated, operating performance of a company. From there, we have operating profit, taking gross profit, netting out any operating expenses. Net profit, so again, next level down of profit, we're taking the operating expenses, the operating profit, netting out interest and taxes, and working capital. All right, so current money being tied up in current assets of a company, money being freed up in the current liabilities. This can bring us to one of our next financial ratios, earnings per share. This is a very popular one that's talked about in earnings releases, and it's something that's very significantly focused on by companies as well, because often performance standards are based on earnings per share. All right, so earnings per share is just net profits divided by total number of shares outstanding. Hopefully one day we'll see the transition focusing from earnings per share to cash flow per share, but still that's an adjustment we have to make as analysts. We can translate the rest of those profit measures we are looking at into ratios now, right? So gross profit margin, how much gross profits do you have relative to your sales overall? Operating profit margin, again, like I said, the terms that we use are often definitions in themselves, so nothing too exciting going on here once you look at the name. Net profit margin, basically the common size income statement you've already seen. Now we're translating it and relating our income statement with our balance sheets, and these get a little bit more interesting, right? Like we mentioned with return on assets. You need assets in place in order to generate revenues. Return on assets are one of the ways that we can look at the performance of those assets in place and their capability of generating revenues and ultimately the bottom line. And lastly, return on equity, right? Your net profit relative to shareholders' equity of a company. Next, we have leverage ratios. Right, so whereas profit ratios are all trying to give us different metrics on gauging a company's profitability, the ability to generate value, now we're looking at companies' ability to pay debt, but also how much debt is used to fund the company's operations. All right, so debt to equity. Broadly, this is just a measure of how much liabilities the company used relative to the equity that it's built up over time. All right, so typically, profitable companies will see this declining as they either reduce their reliance on external capital or increase their retained earnings over time through plowing back profits, or some combination of the two. Debt to assets is a similar metric. And then interest coverage is looking at the company's ability to pay its debt outstanding in any given year. Right, this is a very important metric, and it's part of the reason that companies can face serious financial distress when they over-leverage themselves. If companies don't have sufficient operating profits to cover their interest expense by several orders of magnitude, then any liquidity crunch or any time that there's a shortfall in expected revenue, those companies can face serious concerns. And this is also important for us as well. Right? When we take on debt, it's important to understand that we're capable of generating the income that covers that debt, hopefully several order of magnitude more, because when there is a hit to income, that can reduce our ability to pay that debt. It's very important that when you're evaluating a company, it has very relative ease of covering its interest expense. So leverage ratios reflect kind of the broader aspect of companies' ability to pay off their debts. Liquidity ratios are a little bit more short term. Right, so the current ratio is a measure of current assets to liabilities. So if we had to pay off all of our current liabilities, do we have sufficient current assets to balance that off? And the quick ratio is just a more liquid version of the current ratio. So inventory is usually one of the less liquid versions or less liquid components of current assets. So net of inventory, what is our ability to pay off our current liabilities? And then we have our sales efficiency ratios, right? Sales don't come from out of nowhere, right? Income statements are tied through, are technically tied to balance sheets through net income, but it's also converse that we need assets in place to produce our sales. All right, so what we're looking at with efficiency ratios are just different levels of balance sheets and how much of that balance sheet asset are we needing to generate our revenue. So total asset turnover, it's looking at the total amount of assets that the companies need in order to produce $1 in sales. Similarly, property, plant, and equipment. How much property, plant, and equipment do you need in order to produce each $1 of revenue? How much cash do we need on hand? Usually this is a little bit more of a liquidity ratio. Cash is the least productive of the assets on the balance sheet. Literally, typically just held for liquidity crises, just to have a little cash on hand, or to take care of investing opportunities should they come up. And working capital turnover. Working capital is very often needed to produce sales, right? Often you have to make sales on credit. Often you need inventory on hand in order to produce a sale. So working capital is a little bit more relevant to that sale generation. All right, lastly, we have some market ratios. So price to earnings. This is another popular method along with earnings per share. So what is the market price per share relative to the earnings generated? Price to book ratio. This is also an extremely popular method of valuing companies. So what's the market price of the company relative to the book value of assets? Over time, we should see that value generating companies are increasing these values. What is the dividend yield? How much dividends are being paid out per share relative to the market price of the company? And dividend payout, relating our dividends to the earnings being paid out. Important to keep in mind, a lot of companies do not pay dividends, right? There's been a declining trend in the number of companies paying dividends over the last century. So while you do have all these ratios available to you, they're not relevant to every company you're going to be looking at. Right? If your company doesn't pay out any dividends, then there's no information that you could get from dividend yield or dividend payout. There are substitutes you could potentially consider. So does the company engage in share buybacks regularly? Something like that. But not all companies pay dividends, and that's okay, right? Not all companies should be paying dividends. They don't have the cash flows necessary to sustain those dividends over time, or they have a lot of value-adding opportunities that they can invest in. So rather than paying out a dividend, retain your earnings and invest in those projects. Oh, and last little thing, just sales growth. Looking at a company's increases in sales are one of the top line things to always consider. Over time, companies should be extending their sales. So if you don't see that, then it could be an issue. Any questions on the financial ratios? All right. I know it's a lot, basically laundry list of things to consider. But again, the important thing is not that you necessarily memorize the ratio itself so much as the economic context. When we're looking at the profitability ratios, we're trying to look at different metrics of companies' ability to generate value. When we're looking at debt ratios, we're trying to consider, is this company over leveraging themselves? Is leverage the only explanation or the only reason behind this company's growth in revenue over time? Liquidity ratios. If there's a liquidity crunch, is this company going to be able to handle the debt that's outstanding? Rest of the performance ratios, similar ideas with that. We're trying to consider what is the company's ability to generate value relative to market value, to dividends, to sales, assets in place.